I know it's disheartening to see when you look at your portfolios that you've lost money even though you've been a disciplined investor, but that's the nature of the market. Stock markets will remain volatile, and that is the reason why equity investor will always get a premium if you are genuinely invested for the long term. You cannot compare the high point of the cycle and the low point of the cycle and do an instant analysis. Here's how data looks like, and we've looked at 3 previous crises. In September 2001, if you bought stocks 1 month at the peak of the crisis, peak of the 9/11 crisis, within a month you made 14%. After 1 year, you made 13%. 2008 GFC crisis, if you bought stocks after Lehman Brothers collapsed, you had a pain, but in next 1 year, Nifty gave you a return of nearly 90%. And then the macro sell-off in February 2018, which is Feb 2016, I beg your pardon. Nifty gave you a return of 8%, but in next 1 year, it gave you a return of 27%. So for somebody who's not a very savvy or a sophisticated investor, and if you want to really start rebuilding your portfolio, if you want to check on your asset allocation, I would say index investing really makes sense. It's easy, it is safe, and it is something where history or historical data has been strong and supportive. We're pitching for the fact that never waste a crisis, and how can you convert this crisis into an opportunity if you're a long-term investor? Then start revisiting your asset allocations. And your current allocation, if it is tilted currently away from equities, you need to bring it back. I'll say it again, time is not about panicking now. Time has come to start really reassessing your risk profile and perhaps look at your asset allocation. If it is significantly away from equities, you need to correct it. Okay, I'm just going to change gears.